So the market's in the red today. Investors are bracing for that potential U.S. government shutdown in the impasse over the budget. However, September has been a wonderful month so far for investors. Let's get more from Darius Dale, founder and CEO of 42 Macro. Great to see you, Darius. Thanks very much indeed for joining us. You're in the camp that says if we do get a U.S. government shutdown, it shouldn't be a huge deal for the market.
Yeah, that's correct, Andy, and thanks for having me. When you go back and you look at these government shutdowns, what we find is that there's really no material impact, bullish or bearish, with regards to these outcomes. But when we look at the longest government shutdown ever that spanned from December of 2018 through January of 2019, we actually saw the S&P 500 rally 10% during the shutdown and rally a further 10% in the 3 months after the shutdown. So perhaps the government should shut down more often.
Yeah, it is interesting. I remember years ago there was a doctor strike in Israel and the death rate went down. But I'm being facetious here. It was partly because operations were postponed and they can be dangerous. You say there's a chance here of explosive upside in risk assets. What do you mean?
Yeah, that's a great question. I think this trend of double-digit returns that we've been experiencing in the S&P 500 and explosive growth in assets like gold and Bitcoin is likely to continue over the long term. We continue to see the U.S. administration continuing to legislate a mix of growth-friendly policies that are designed to outgrow the growth of the debt. And we know that we're adding 5 to 6% of GDP's worth of debt every single year in terms of the size of the budget deficit. So it's our view that the net result, the cumulative impact of all the fiscal, regulatory, and trade policy changes that are being legislated is likely to contribute to a much significantly faster economy on a 12 to 18 month forward time horizon. And you have to position for that as an investor.
Just a much stronger economy, even in the near term. I mean, some of President Trump's policies are likely to, if they stay in place, are likely to take years to mature.
Yeah, that's a great pushback. And so we've been coaching our global investor community to anticipate what we call a U-shaped economy since we authored this paradigm C theme back in April. And what we mean by U-shaped economy is that there are a lot of the policy sequencing plus a lot of the hangover from the previous administration's policies are likely to contribute to ultimately a nadir in the economy sometime around Q4 of this year. But looking ahead, we think markets are smart enough and wise enough and have been since we authored this paradigm C theme back in April to look through the worst part of the U-shaped economy into the other side of the U. And that's ultimately that robust recovery we've been anticipating and guiding our clients to.
You reckon that the Fed should just come out and admit it and say 3% inflation, that's an okay target?
Yeah, well, in our view, we think we've been calling for the Fed. Our models would suggest that the equilibrium core PC inflation rate in the U.S. economy has been somewhere around the high 2s or low 3s for almost 5 years now. And so it's our view that the Federal Reserve has been maintaining monetary policy too tight as a function of its arbitrary 2% inflation target. Now, we've amended our views on this recently to suggest that it's probably not wise for the Federal Reserve to come out and explicitly target a 3% inflation target amid so much, political backlash. But the choice they can continue to make is essentially implicitly allowing for a 3% inflation target, which will allow them to drop the term structure interest rates in a way that is more beneficial for the economy and the labor market.
Now, you say that the U.S. dollar is likely to be weak for another 1 to 2 years. Why is that? Start off with that. Is it partly because of the deficit growing?
Yeah, no, it's a combination of factors. So our models are suggesting that our models are pointing to the major central banks that the dollar is paired against. If you look at the ECB, the Bank of England, the Bank of Japan are either done easing monetary policy or they're actually normalizing monetary policy in a hawkish direction with regards to the Bank of Japan. And then so the U.S., which is now starting to catch up and will likely accelerate that catch-up process in the coming 12 to 18 months, is likely to weigh on the dollar. Another factor that's likely to weigh on the dollar is this, going back to the dollar smile thesis. Whenever you have a globally synchronized recovery, particularly one that is led by the U.S. economy, investors want to take more risk. And when investors take more risk, they do that typically in dollar-based transactions. And so ultimately, the supply of dollars that are going to hit global capital markets over a medium to long-term time horizon is likely to be quite robust in a way that favors a much lower price exchange rate value for the dollar versus major currencies.
I'm just wondering, will that incline foreign investors to avoid U.S. stocks because they'd be worried about taking a hit on the currency?
Yeah, no, I don't think if you're an international capital allocator, you cannot afford to not be invested in the U.S. I mean, we know that it's either going to be the U.S. or China that quote unquote wins the AI race, although I'm not sure anybody's actually ever going to win it. Nobody won the internet. But the reality is you cannot afford to not be invested in the United States economy. So what's likely to happen is the hedge ratios for foreign investor portfolios are likely to continue to rise. And as a function, and this is reflexive, because once those hedge ratios start to rise, you tend to see currencies trend for multiple quarters and years because the hedging costs start to rise alongside those hedging ratios, and it ultimately lowers the net return of the assets that they're invested in. And so ultimately, this is a reflexive process that should feed on itself. But the key takeaway here, from according to our models, is that this decline in the dollar that we're currently anticipating is likely to result in a much higher stock of global liquidity on a year plus on a 12 to 18 month forward basis, and that's incredibly bullish for asset prices.
Darius, thank you very much indeed. We covered loads of ground there. Really appreciate it. Darius Dale, founder and CEO at 42 Macro.